All right, so the last part I mentioned is we want to do the what I'll call the implied comparables or implied multiples. So in this case, we'll go to Bloomberg. We'll look up Amazon, the company we're talking about here. And then we'll go to the RV section for the relative valuation of, in this case, Amazon. And again, we said we would use the Bloomberg peers. And right now, it's listing these companies as the Bloomberg peers for Amazon. We'll select the stats. We'll use the market cap weighted average. And remember, you want to have 6 peers. But in this case, what we'll then do is we'll go to the custom tab, and we had the multiples template that we had created last week. Right? So basically, we have our format already for the multiples. Now, here's what I want to do. Output to Excel. And then remember, anytime you dump anything from Bloomberg on one of those computers in the lab to Excel, it's going to give you that warning there. Okay? So just be very careful about that warning that you don't hit that. You have to hit the yes button or else you'll be waiting a very long time. So basically, it dumped out all of the data here. And again, for the things that are NA, then what you can do is just find and replace. So wipe the NAs N/A and replace them with blanks. Well, theoretically. I don't know if I spelled it right, but in this case, I'll just wipe them out. Yeah, let me just do this. Clear the contents. And the only reason I'm clearing the contents is that, as I said, what Excel does is that, in this case, the market cap weighted average is an average. But the problem is it treats NAs as a number in your average. And so it will distort your averages in Excel. It's just really just a Microsoft problem, right? So that's why leave them as blanks. Notice if I leave this as 0, it will actually change the growth rate for the whole market, because basically it includes the 0 in the average. If you have a blank space, it doesn't include the 0 in the average, and it makes it a bigger number. And then just to make it a little bit more legible, it might make sense to put this into 2 decimal format. And then finally, we have to make sure that we actually have numbers. So copy, paste special, values. So I want to make sure these are numbers. So again, if I go outside the lab, I actually have this as data. So what I'm going to do is I'm going to call this, save it to my shared folder as an Excel workbook. I'm going to call this Amazon Comps. All right. So now what I'm going to do is jump back over here to our model for Amazon, where we're building out their valuation. And in this tab, which I'll wipe out here, I'm going to go to the new model. What is it? That I just created. And basically, I'm just going to take this data, copy it, and put it in this model, paste special values. And as I said, I'll probably change the formatting here to 2 decimal places just so it's easier to see. All right. In fact, I know who these companies are, so I will wipe out the ticker. All right. So here's the point. We have this Amazon series of multiples that the market is giving us today. Well, in our model, guess what we also have? We have a calculation of enterprise value. We also have a calculation of forward sales, forward revenue. We also have a calculation of forward EBITDA, forward EBIT, which we're using operating income as a proxy for EBIT. So in our model, we can essentially calculate the ratios using our model forecast that the real world is calculating based on actual pricing data, right? And so basically, this is what I call the implied comps. And what I mean by implied comps is for the model data, spell correctly, what comps does, in this case, under the ratios, a $276 share price represent? Okay, and so that will give us what we're forecasting as the multiples for these companies. Does that make sense? Okay, so we'll go through the ratios. Now, enterprise value is the one tricky one. And the reason it's tricky is because the way that we calculate enterprise value and the way the rest of the world calculates enterprise value. So let's talk about the way we calculate it, and it'll be easy to see this in our valuation. How do we calculate enterprise value? We take the operating value of the firm, we add the non-operating value, and that equals the enterprise value. And that also equals the value to all the interest-bearing debt and the value of the equity. Those two together, enterprise value of the debt and equity, equals the enterprise value of the assets for the operating and non-operating. Right? That's our method. It's an M&M model. Right? Now, I'm going to show you Bloomberg. When you go to Bloomberg, Bloomberg also calculates, under the financial analysis section, they have a tab under key stats called enterprise value. You can get there directly by typing in the short code FA space EV. So it'll bring you to the financial analysis screen, and it'll bring you to the enterprise value sub-tab. All right, but if you just typed in FA, clicked on summary, and then clicked on enterprise value, clicked on enterprise value, you can get directly to that screen. All right, but here's the point. Here's Bloomberg's calculation of enterprise value for Amazon. This. How is that different than the model? Cash is there. So they're subtracting the cash. Why are they subtracting the cash?
Because when you buy a firm, you get the cash with it, so you don't really. It's like when I buy
The net debt, you get the cash, but it's non-operating. That's the key I was looking for. It's non-operating. So let's go back to our definition of enterprise value. Our definition of enterprise value, if we look at the debt and the equity, does that include the non-operating? If we add these two up, is non-operating part of this? Well, in terms of this side of the equation, no. So what have they really done? They've taken this side of the equation, all of, and look what's here, cash, preferred, minority interest, debt, and equity. Market cap is the value of the equity. So we have essentially the value of the equity and the value of the debt. That's what we call enterprise value, to get to what I'll call the Bloomberg equivalent enterprise value, which is also used by Thomson Reuters and Cap IQ. We subtract off the cash. So what are they really doing? If cash is primarily the biggest non-operating asset for companies, and if we take enterprise value and we subtract off their cash, what are we left with? Operating value. So basically, the market's interpretation of enterprise value is closer to our interpretation of what we would call the operating value, because they're taking the debt and the equity minus all the cash. And cash is a non-operating asset. Now, we can argue that that isn't necessarily clean because there's some other non-operating assets we're now mixing in with an operating value. But here's the other challenge that we have. They take out all the cash. The debt holders in no scenario will get all of that cash, because the government's going to come in and say, what about our taxes? The employees are going to come in and say, what about our unpaid salaries? There is just no circumstance where a firm is going to be able to pay all of its cash out to the debt holders and have that hold up. That is why McKinsey created the concept of operating cash. We shouldn't realistically subtract all of the cash because some of the cash just cannot be paid out. In the market takes a more simplified approach. They just assume all the cash can be paid out. And like I said, sounds great, but in practice, won't ever happen. And so that's why we need to figure out what is an appropriate amount of excess cash, because that's what is going to be paid out versus operating cash, right? And so our model's enterprise value is different than the enterprise value that we see in Bloomberg because it's really doing an operating value. But that's also why I go back to the key value drivers equation to help us explain the enterprise value numbers, because if operating value in our key value driver equation is really what they're using in Bloomberg and CapIQ and Thomson when they use these multiples, then the drivers of that are growth, ROIC, and WACC primarily. Influenced by the non-operating, they took the cash out, so really it's the non-operating assets, gains or losses, tax rate, and interest expense capital structure differences that should distort things. So again, if the peers don't have dramatic differences, it does make for cleaner analysis. Does everybody understand that? What we're saying here is the difference. So here's the point. What I need to do, and I'll just do it on this screen, is I'm going to call it the BEV, which stands for the Bloomberg Enterprise Value Equivalent. So we have it in our model. So if Bloomberg were to calculate enterprise value, what would they do? Well, what they would do is they would take, in this case, the enterprise value of the firm, and they would subtract from it all cash, right? Because it's basically all this debt-related stuff plus the common equity. Actually, what they don't include in is the retirement-related liabilities. So let me take that back. So equals common equity value plus minority interest plus preferred stock plus interest-bearing debt. So I'm just basically recreating this equation. And then I'm going to subtract out all cash. So it's these four things minus the cash. And in this case, what I want is I'm going to go back to the actual balance sheet, or I can do it off of my balance sheet. But the point is, I need to do both operating and excess cash, as opposed to just subtract out the excess cash, because they use both. So for 2012, it's minus that and minus that. So notice that their enterprise value is a little bit different. Questions about that? All right, so now let's go recalculate these ratios. Implied comps. EV to, in this case, sales 1 would be, take my enterprise value from Bloomberg equivalent, divide by sales 1 would be from the income tab. Which ones are sales 1 on here? 2013. Equals, from our valuation, enterprise value divided by sales 2, 2014. Equals enterprise value divided by, in this case, back to the income tab, 2013 for EBITDA equals enterprise value to EBIT. You notice I'm using relative references. 2000, sorry, I don't remember which one I'm on. Next year's EBITDA equals enterprise value to 2014 EBITDA equals enterprise value to EBIT finish this up real quick. Divided by the income tab, 2013 operating income equals enterprise value divided by 2014 operating income. Next, PE equals share price, which is our calculated share price, divided by earnings per share. And I don't know if at the bottom of the income tab we had earnings per share. So what I would do is I would take next year's earnings, and next year we're using the 2014 earnings. So we would take the net income in 2014 and we would divide that by the shares outstanding. Okay. So there's your forward PE that we're calculating the model, right? And then what is the PEG ratio? The PEG ratio is this divided by the long-term growth rate. We didn't really forecast a long-term growth rate in the model, so we can't really calculate a PEG. So we're not going to directly calculate the PEG here. We could if we want to put our own long-term growth rate, but we could then do the price to book equals the price is basically the common equity value. The book is the balance sheet historical book value of equity, total equity in 2012. So point is, what we've done is we basically just put into our model what I call, as I said, the implied comparables, implied comparables. How do you want to pronounce that word? What does this help us with? Why do you think we would use this?
Terminal value.
Helps with terminal value. Because what we have here is kind of a range of possibilities of growth in ROICs, a range of value that the market foresees that these companies could potentially achieve. And so one of the things we want to ask ourselves as a second sanity check is, how does our valuation compare with the actual trading ranges of companies in this industry? So right now, as we can see, they're slightly different, but they're still within a reasonable range of some of the other players in the industry. And so that's really the point. What I don't want to see is, I don't want to see where the industry is at 2.68 that suddenly I'm at 5. Because I just have to question, like, why am I so far out of what the industry is trading at? Right? Because what am I seeing that the industry is not seeing when I'm making my assumptions? Because that's where we have to go back and answer the question. Because if we get something that's dramatically different than what the world is seeing, it's not saying we're right and they're wrong, but we at least have to understand where we disagree on the assumptions that cause them to come up with their values. So that's really what this is. Just like the ROIC chart is a test to see what we're kind of forecasting ROIC in the futures are, knowing that ROICs tend to regress towards the mean. What happens when we look at the multiples ranges across the different multiples for our companies compared to their peers? Does that make sense?
What's the reason? Because on EBITDA, you have quite a difference between 18 and 5.
Yeah, well, I think in income 6, E21, 7, 6, 8. I also want to make sure I have the right one. 7 to 6, 8. Just make sure I have the right, because I was copying and pasting. So income E6, I6, and that's 7. They should be the same number, right? So let me try this again. Equals Implied Comps, what's up, the DC valuation, enterprise value divided by, what year again was this? Next year, so 2014, that was EBITDA. Row 7, right? There we go. So it does help if you actually put the formulas in correctly. Because if you have wrong formulas, it makes it even more difficult to explain the data. All right, but again, here's the point. At least I can see these are within the range of the industry. And same idea, am I, with my forecast, trading at a discount or premium to the market, and why? Because again, I know what assumptions I put into the model. So this is my other recommendation for next week that you use as part of your sanity check for your the fourth part of your group projects. So basically, I will post this file. So I'll call this file save as Amazon as is. I'll call it with comps. And I'll post in just a couple of minutes to Elms so that you can have this tab already there as your own little template. Yes?
So were you saying the as is for this as well, right, for the online?
Well, this was the as is, but I'm saying as I change, I just happen to be using the as is file. But as I change the value, these multiples will change. So for example, let me just come back here to the ratios. And if we took, for example, in these out years, I made this 70%, and I got $110 share price, then notice that these implied comps would be dramatically different. But that's the idea. So just as our assumptions are changing the share price, our assumptions are essentially changing the multiples. And the one thing that we're doing is we're linking these two methodologies together because they have to be. You can't value the company on a cash flow basis and a multiple basis and get two different answers because there's only one price for a company. So eventually these two have to intersect. So this is just our way of seeing how they would intersect. All right. Questions about that? So I'll call this the implied comps.
Line number 10 should match Amazon.com.
Yeah, this is the model data for Amazon. Well, again, here's what's primarily going to be different. This is at a share price now of, what are we at, $110 a share. So like I said, it's not going to match right now because we just created a weird share price. But if I come and I undo this, 276. Now, Amazon today is probably not at 276. Actually, I'll do a Google. Well, let's look in Bloomberg here. Just graph the price. Amazon today is at 307. Anybody buy them in the last week? So this is what I'm saying about, Vapor. They just went up 10% last week since we valued them. There it is. We missed it. Yeah, because is that back to that expectations game? People are just buying Amazon, and they're thinking they're going to do better and better and better. And you're going to sit in this class, you're going to say, a year from now, damn, I missed out on this. And then 2 years from now, you're like, thank God I didn't get into this. All right. The question is, how long before that happens? And that's the thing. You can make money in the short run in a trade, but eventually, when those expectations get adjusted, that's usually when people lose money. That's why everything we're doing in this class, I'll make one last comment, think of it as something for 5 years value, as opposed to this is what they're going to trade at tomorrow, because there's just too much that goes into short-term expectations to try and back to figure out. Amazon? Well, they have projected free cash flows.
No, but currently they don't have
No.
anything.
No.
So, but they've been in business for what, like last 10 years?
Mhm.
And they don't have any free cash flow.
No. Because Jeff Bezos is pouring every dollar into growth. Just going back in. And he doesn't care about margins. They have no margins. They have no profits. They have no free cash flow. And they're worth probably now $140 billion. All betting on the future. That he's making a bet long term that they will dominate in the long term. I'm just saying, you got companies, Barnes & Noble, the last one, is in the hospital thanks to Amazon. They did a little drive-by shooting. They killed him on life support. And every time he goes out there and guns down one of his competitors, share price goes up. But I'm telling you, there's going to be some big bullies that are going to come into town and challenge them one day. And I think one of the bullies that's setting up for this fight is Walmart. And Walmart's not going to back down for this. They got too much at stake. So they're not going to drive Walmart out of business. I'm just saying, down the road, I just worry about Amazon's. I'm not saying I don't love them as a company. I love them as a customer. They're great. I just ordered Sony speakers that don't work for them. But basically, and I'll be able to return them. So they're great with their return policy. It won't cost me anything to ship them back and forth. But I'm worried about their stock price. Like a stop loss or something, yeah.
Yeah, and then they come out with news when the markets are closed, and then your opening price could be is that the institutional buyers that
Yeah, and what's happening now that the regulators are trying to get their hands on is that we now also have these after-hours markets, which are kind of unregulated between the brokers themselves, and that's the problem. Is that it used to be that you'd have to wait until the next day. Now, for some of the bigger stocks, you can trade 24/7. So they're either listed on multiple exchanges or they're trading in these kind of loose regulated, or unregulated completely broker pools. And as an individual investor, you don't have access to that unless you're very rich.
so you can just get if there's damaging news on closing.
For example, there was a fire on a 787 in Heathrow on Saturday or Friday, and Boeing stock price went down 6%. But here's the thing. Anybody see the news today about them? At least in the FT. So right before class, I checked the FT, Financial Times, which is out of London. And basically what they said is the preliminary investigation had nothing to do with the batteries. So what do you think is going to happen to Boeing stock price on Monday? It's going to recover. So Ethiopian Airlines did not ground the fleet, and there's no grounding of the global 787s, which is what everybody feared was going to happen after the fire. But after that initial panic and the quick selling, my guess is you're going to see an adjustment on Monday. And the institutional investors that could take advantage of that have already done it. Too late for you and me, because by the time the market opens on Monday, Boeing will open higher. Be my guess. Now, if different news comes out, things could change. Yeah. Sorry, not the model. Model.
One of the implied comp ratios,
Mm-hmm.
it was within the range for the comps for the model that we put together. It's F, but it's considerably less than Amazon analysts. So as long as
Yeah, I'm not trying to get you necessarily to sync with this one and that one.
Yeah.
I'm just trying to get you to say that, given what we are calculating the model, which is most likely to be different from the actual share price anyways, and even with a company, it's bouncing around every day. Just where are we relative to that snapshot in time with the industry's point of view? So that's really the point. Is like I get a general sense of what trading values are assigned. I get a general sense of why the trading values are assigned because I did my multiples analysis with the higher ROICs or lower ROICs versus expected growth rates. And then I kind of have my valuation, which is also based on my forecast of growth margins, which applies the ROICs. And I'm just trying to see, does this kind of make sense to me that my proxy ROIC growth assumptions are going to work against what the market is saying could be earned by various firms in the industry, particularly if there's ones of different sizes. And I'm not saying it can't be different, but we should at least be able to explain why we think it's going to be dramatically different if it's going to be different. Same with the ROIC chart. So an upwardly sloping ROIC chart isn't necessarily impossible to achieve. You just got to explain how it's going to happen because you're explaining the exception, you're not explaining the rule. Right? So that's what we're really trying to do here. Other questions? Yes?
For the assumption tab, what is G then? It's not long-term growth?
For the assumptions tab, it is long-term growth, but it's growth in cash flow. So this G is growth in cash flow. The G growth is growth in EPS and Bloomberg. As I said, they're not really quite the same thing. We're primarily using the long-term growth in the Bloomberg model as a proxy for the directionality and the relative rankings of growth and growth in cash flow. But to be honest with you, they can be different. And that's another reason why you can see some abnormalities when you do your analysis. All right. So this is the last part I would mention to do with part 4. Obviously, sync through your presentations.